Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, September 29th, 2015. In this video, I wanted to take a look at the U.S. stock indices, the broad markets, and provide some of the rationale and reasoning behind closing out a lot of my short positions today before the bell and going long a position of IWM. May add to that tomorrow, or I do plan to add if the charts continue to play out as I think they may here. But as of now, it's a starter long position. It does bring me to for the first time in a long time, into a net long positioning, the IWM along with the biotechs that I went long today. And the reasoning is this: as I stated earlier in the static post, and I've often stated in the past on the website, when going long, looking to reverse as far as swing trade positioning, I'm not talking 1 or 2 day quick bounce trades, but trades that may last for anywhere from a few days, more likely at least several weeks, and possibly a month or more. When doing that, I like to see 60-minute divergences. I should clarify, bullish divergences on the 60-minute time frame, ideally with the markets falling to a key support level, and that usually will coincide. In other words, I'll put probably the highest weighting in the markets falling to a support level, and then if and when that happens, and there's other confirming evidence out there, then I will often, at the very least, reduce my short exposure and sometimes maybe take some hedges on the long side, or in this case, go net long. Again, as I mentioned, there is a possibility that the markets fall apart here if that the bearish pennant on the daily charts that I had pointed out, if that does play out, the markets will most likely continue to fall very sharply in the coming days, because with bearish pennants, usually the move leading down into the pennant formation, the move coming out of it is just as sharp and roughly equal in scope. So again, that may or may not happen. Obviously, I don't believe it will happen at this point, and that's what I'll talk about today. This is the S&P 500. Before the close, I put up the chart of the IWM, and what I'm looking for, and we still may get it. I had mentioned the most probable scenarios, in my opinion, would be a move down to test these former August 24th, the reaction lows. That is a very key support. A lot of people are watching that level. And as I stated on the site, one of two things will happen assuming this level holds, is more than likely we're either going to fall just shy of it. And what that does, it leaves a lot of people out, those people looking to buy that dip to support. Or on the flip side, in these cases, usually we'll overshoot it. Maybe we'll get a momentum overshoot. Now, tell you what, I wouldn't be surprised, and I'd almost expect a gap down in the morning, somewhere around these levels here. Let's draw it out if I could. So let's say we, gap down in the morning somewhere slightly under those levels, and then a reversal. As I mentioned on the site earlier today, I'll draw these lines out here. What that will do is give us positive divergence. Now we almost have it. I mean, if you want to split hairs, if you look at the S&P, we're just slightly above. Let me clear these lines. We hit a low today of, what is that, upper left-hand corner, 1871.91. So we'll call it 1872. And back there on the 24th, this is the 25th, the next day we revisited those lows. The low was around 1867. So as you can see, we're essentially at those levels now, just a hair above, and that may be close enough, not by the book, but if you look at the MACD, we're making much higher highs. So whether we do punch below, if we do get that quick flush out move, that will certainly put in bullish divergences. But you can have equal lows as long as you still have a higher low on the MACD, higher lows on the RSI, which we do have here, as you can see I've drawn out. And again, I pointed that out on the site. So that's reasoning one. And again, the S&P 500 is only one of several broad diversified U.S. indices, so we're going to look at the others, and I wanted to point that out. Of course, these RSI oversold readings, as you can see here, the arrows mark every substantial rally that we've had here over the last few months has resulted when these oversold readings have when the RSI has crossed the oversold level. In this case, we had a double tap. This was actually divergence. You can see the line there. So we had oversold, came back down to form a higher high, and then we took off. In these instances, the markets became oversold, and as soon as they crossed back over, that was pretty much it. So you can see they've led from either relatively small rallies, yet tradable depending on your time frame, and of course these were barely oversold levels, but they did tag that 30 level on the RSI, and it's these deep oversold levels that you get these lasting rallies off of. And now we have this one, so it is possible we get another move down and we come in here somewhere. We could put in a higher low. We could put another divergent low here on the RSI, you know, if prices move down a little bit and the RSI comes back to make a higher low. The RSI. The MACD still has plenty of room if it wanted to move down a little bit, if the markets, if the S&P 500 does come down lower, because our previous reaction low was all the way down here. We were really stretched. So one potential scenario, see this keep moving down, and then, you know, divergence forms, say, at this level or so. So I'm watching that. That's why I didn't get too aggressive, because I can see the room for downside. But again, ideally, for me, would be to see a gap down in the morning, which I would add to my positions. You know, I'll evaluate everything else depending on what that gap looks like. Maybe sit back for the first 30 minutes or so in trading, and then add, because if we do gap down and break back up above this level, those divergences will be in place on the S&P 500, and just the fact that we've taken back that level will be a bullish, near-term technical event. And if you start to see some volume coming into it, there's a good chance we can run. All right, so let's just quickly go through all the charts here. The S&P, that was the S&P 500 itself. This is a SPY, the tracking ETF, and as you can see in this case, it actually has matched those lower lows. Now what I did is I cut off this reaction low. You look at the long candlesticks, as I mentioned several times on the site, there were quite a few mini crashes, not just in individual stocks, but even in widely held ETFs, like the QQQ had a huge mini crash compared to the NDX itself, the SPY. So this, to me, the word aberration wouldn't be accurate, because this actually happened. We must have had these prints down at this level, but I was trading that morning, and I can tell you that this only lasted seconds, if not minutes, that opening gap down, and prices ramped right back up quickly within, as I said, within either seconds or just minutes. And so I pretty much, in my mind, that long candlestick wick is not accurate there on the S&P, or on the SPY, I should say. So I'm looking more along how prices looked on the S&P 500, which is what this is supposed to track. And so what you see is now we have matched those lows. So we do have positive, i.e. bullish divergences in place on the SPY, which is enough. So that's why I went ahead and took a starter position. I also think the IWM, we'll get to that right here. The IWM, you can see, has much stronger divergent, has put in a divergent low already. The MACD is starting to curl up. If we take a look, we haven't had a bullish crossover yet. When this blue line crosses the white line, that'll be a bullish crossover. I don't believe we've had that occur yet. Deeply oversold readings, which, as I've indicated earlier, that has marked all these other, significant rallies here, and whether we go a little lower or not, I would say odds are pretty good. We're going to have a pretty nice sharp snapback rally, and being that this is a 60-minute time frame, that rally could last for days or even weeks or more. So that's how I'll position, and I'll get into probably follow up tomorrow with some suggested stops on an IWM trade, or TNA, I'm sorry, whoever took that, and as well as my targets, which I believe I already had listed on the chart. Okay, here's the Russell 2000, which of course we were just looking at the IWM. That's the tracking ETF, so I haven't had it drawn out yet, but as you can see there, here are those divergences as you would expect on the IWM. So strong divergences in place, and ultimately I could see, just like as with the IWM, if things do start to pan out, and again, we take this step by step, minute by minute in this market, but ultimately this downtrend line coming in that I've had here drawing on the 60-minute chart for weeks now, we have some horizontal resistance right there around the, it's hard to see here, 1195-ish area. So just eyeballing this chart, and from my experience with how quick we'd probably go up if this does happen, and when we'd get there, those lines would probably intersect somewhere around right here, which I can even give you a date on that. This is just a rough guesstimate. Let's say they comes in around here, mid-October, call it. So we could be looking at a rally for about 2 weeks, again, if this does pan out. And if it doesn't, here's the good news on that for those of you who are long, we'll probably know very quickly. If we take out today's lows by quite a bit, and the markets keep going impulsively lower, we're probably going to continue and flush out here and have a substantial move lower. As I posted earlier today, I'm looking for about, if that bearish pennant plays out, about another 4.5% downside on the markets. I should reiterate, that's from yesterday's close. I put that post up this morning. So there's probably about another, I'd have to look at the Russell and the QQQs, but those indices are a little more volatile, so you'd probably expect maybe 5-6% or more downside on, especially the NASDAQ 100. I still think that has the most potential for the downside in this bear market. Okay, for those of you who like to trade the Midcaps, the Midcap ETF, the non-leveraged ETF is MDY. What I'm looking at here is the Midcap S&P 400 Midcap Index, I should say. And it looks very similar to the Russell 2000. You have this downtrend line here, which would serve as a likely price target. If prices continue higher, I would actually target somewhere around here. There's a fat gap at this point. We have that reaction high here from just a couple of weeks ago, the 17th, that is. So that would be my ultimate upside target on the mid-cap index there. And again, you can see prices have made a lower low. They undercut those lows by just a slight amount. And we have potential, I call it potential divergence. Keep that in mind. I often talk about confirmed versus potential divergence. I call this potential because the MACD is still moving lower. Once I see both lines curl up, we see this bullish crossover, which it looks like we may have looks like they're pinching. It's poised for a bullish crossover, so should the MACD move up, which it will, of course, if prices do, then we have it curling back up, and then I would say these are confirmed divergences. Right now, they're just potential. They were potential here. They were potential, I should take that back, because until we made the lower low in prices, we really didn't have divergence. So at this point, they're potential. And if we curl back up and prices move up, it'll be confirmed divergence. I also talk about when using the RSI as a buy-sell indicator, it's not the tag of the oversold level. Sometimes we have these quick kisses like right here and right here where it tags the oversold 30 level. But if we have an extended or deeply oversold readings, those can last for days, weeks, depending on your time frame I'm talking. And in this case, it's a 60-minute chart. But what I like to see is a move back above the 30 level, which is this dotted green line. And so again, on any upside tomorrow, that will be the case. We have this cluster of trading here that happened throughout most of today. And if we can get up above there, that will be a near-term bullish event, which can take us higher. Price targets, I don't have them listed here, but this looks like it'd be your first decent support, or I'm sorry, resistance around the 1380-ish area. Okay, this is the QQQ. I know a lot of you like to trade the Qs. I do, whether it's derivatives, such as NQE minis, options, or any of the various leveraged ETFs out there. The QQQs are definitely one of the, if not the leading index, and has been in the last couple of years, led this market up. A lot of tech stocks, and again, in the, are we in a new bear market, as I suspect, with more downside to come in the coming months, possibly, looking out maybe even a year or so, then I believe that the Qs have a more downside potential than the S&P 500. I won't get into the reasons now. I've talked about that before. But what we're looking at here is prices just like this S&P 500. very close to retesting those lows, as I mentioned before, numerous times after it happened. This is, again, not for lack of a better word, an aberration. This was just a mini flash crash. This candlestick and the drop in the Qs did not align or match up with what happened in the NDX, the NASDAQ 100. Prices snap back. So this is really our reaction lows from that morning, if you will, if you discount that mini crash. And we're there. Like I said, we're right up to it. Nice little doji, but again, on the 60-minute chart, I wouldn't put too much into that. So we either reverse from here or we punch down lower, but again, like everything else, potential positive divergence forming. Even if we undercut these lows, we'll still have that bullish divergence in place. You know, the MACD would have to go down quite a bit, which it can do. I'm open to all possibilities. But this was the rising wedge. It was shown on all the major U.S. indices on the 60-minute charts, and I pointed that out just over a week ago. This is really what kicked off this next leg down here, was that breakdown of these wedges. So that was a very well-defined, easy entry, easy short entry add-on, as was the push back up to these resistance levels, you know, in here. So that's where we're at now. So pretty much is, you know, what I did coming into this is covered my shorts that morning as posted. Started, you know, did some day trading in here when the volatility was nice, and then just started scaling back into shorts here. And today closed out the bulk of those short positions, and now I'm slightly net long, looking to get a little longer, if I can use that word, tomorrow on a push down. But should things melt down, you know, I will be quick to throw out those positions. And if the market lets me back into the shorts, great. If it doesn't, then that's fine too. I won't chase a move if the bottom really falls out of this market. So, okay, this is the NDX, same story. There's the bulk of the reaction lows from after the December 24th and 25th drop. So we're quite a bit above that in the NDX. One thing that's given me pause a little bit is the MACD. I don't like to see these kisses when you see it looked like it was curling up here, and now it's starting to turn down. So we still have the potential for a bullish crossover. Again, as I said, I'm not conservatively long, cautiously long is a better word here at this point. And, you know, on the lookout for anything. But overall, I do think, and I do plan to add, whether we undercut these lows slightly tomorrow or in the next couple days, or move back up, because as I said, it would not surprise me in the least if the markets stop here. I'm talking about the major indices, the S&P 500, the NASDAQ 100. You know, to leave those people behind. I have to imagine there's quite a few long side or bullish traders just waiting for a retest of these lows. And so I think the market either, it's very unlikely that it's going to give the masses what they want. So it's either going to stop right above, leaving them behind, or give them what they want and then shake them out and then turn around and reverse. That's just how I think things might play out. To wrap this video up, let me just put this in a little bit larger perspective. For those of you who've been following the site for a long time, you've known I've made the case for, you know, highlighted these trend line breaks on not just the S&P 500, the NASDAQ, you know, showed the last 3 bear markets that we've had over the past couple decades. A lot of supporting evidence that this was coming, and that when we did have these trend line breaks and we did get the confirmation with the solid weekly close, everything else that I listed, the long-term indicators flipping from bullish to bearish, that we would be, or are, I should say, most likely in a new bear market. You know, by definition, that's a drop of 20% or more off the highs. We haven't gotten there yet, but let me tell you where I think we are. So if we take a look here at the RSI, another simple but effective indicator, as I often say, look at this reading back here. This was 2007. The highs, for those of you that remember, we had the highs back in October of 2007. That's when the market peaked, at least the S&P 500 there, early October. And so it went on to drop, and if you look at this, the RSI tagged or came very close. Let's see, it's hard to get my cursor on it on this scaling, but we're looking at a level right around 30. I'm showing 32 here. So either way, close enough. You can see it come to the blue line. this is what I'm looking at right now. We've been in a strong uptrend. You know, we had one correction. The NASDAQ and a couple of the higher beta indexes actually had a bear market back here. They dropped over 20%. The SPY fell, or S&P 500 managed to avoid the quote-unquote bear market label. It didn't fall a full 20%, but this was, by many accounts, a bear market within this bull market. That was the last time that we hit oversold readings. This is my point. And that one went on quickly to, market to move back up higher. So I'm looking at this, where we are right here. I should say back then in 2000, going into early 08, the market had topped, as I said, in early October of 07. And this is when we became oversold. And then we had this nice counter trend rally that I'll try to grab it here. And if you look at the scale, that was over a 10%, about an 11% rally right there. And that's just in the S&P alone. That's one reason I'm playing the small cap stocks or higher beta stocks, or higher beta than the S&P. In other words, they tend to rise more in a rising market and fall more in a down market. So, I think it's very possible if we get the 60-minute charts play out the way I think they will here, we can have a rally of 10% or more, which is definitely very profitable, especially, getting the timing right, maybe using some leverage on there. That can, result in a gain of, in the TZA position, easily 20 or 30% should it pan out. So as with back then, I think if we do reverse here soon, the RSI is likely to move up. I always like to watch that middle line, the 50 level on the RSI. That's typically a stopping point when tested from above, as we had here. We had a couple tests from above, or when tested from below. So right now, we could get a little more oversold, and I could easily see a rally that, as I said, lasts weeks, maybe even a couple months. Takes us back up to that 50 level. You can see how well it's acted as support here. I'm talking on the RSI. Look at all those numerous catches there. It was a little dip below there, but once that RSI gets above, it tends to, that 50 level often tends to act as support, and now it should act as resistance when tested from below. And then what we would see is this. So this is where I think we are in the playbook right now, or at least in the game. In other words, if this is, let's call it the third inning, or wherever you want to put that. And this should be here soon, hopefully, if we don't get that meltdown scenario that I'm talking about with that, you can't see it on this scaling, but that bearish pennant / flag pattern playing out. And so I'm just looking to trade this if that happens, and then at the appropriate time, get back short again for the next big move down. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.